Good day, everyone. Thank you for joining us once again here at Seaford & Brew for our economic briefing. For this briefing, we want to look at the performance of the Community Bank Benchmark Group for the second quarter. And if you recall, our benchmark group we like to look at are banks between 100 million and 5 billion. So that's the segment of banking that we key in as community banks. Overall, the performance here, ROA up to 1.14%, up from where we were last quarter at 1.06. So we gained some significant ground when we're looking at the overall performance in terms of ROA. And as you can see, even going back to the second quarter of 2017, we're up 15 basis points on ROA. But when we look at ROA, we like to segment this into three subgroups, and that would be the subchapter S banks, and they're typically higher on the scale just because they do not have to pay any corporate tax on the federal side, and for some states on the state side. But overall, we see the performance on subchapter S at 144, very strong. Just 2 basis points below where it was in the third quarter of 2017, but overall they're up quarter over quarter last year, when in the second quarter of 2017 they're at 1.39. So a very strong ROA for that subchapter S group. When we look at the just typical stock banks, you can see they're up to 1.06. So that's fairly strong, up 6 basis points from where they were last quarter. And you can see it's up 15 basis points from where it was back in the second quarter of 2017. So continue to see a strengthening in ROA. And then when we look at the mutual institutions, they too have continued to increase up to 0.65, up 5 basis points from where they were last quarter, in the first quarter, at 60 basis points, and then where they were back in the second quarter of 2017 at 57 basis points. So overall, year over year, quarter over quarter, we've seen progress and strength in the return on average assets. So now let's look at how that's built up inside the inner workings of the bank. Net interest margin had a pretty big increase quarter over quarter, went from a 373 up to that 380. So very strong. We see that pick up. And year over year, we're picking up also 3 basis points from where we were back in 2017 in the second quarter at 3.77. So net interest margin is faring fairly well. And we split that up into the yield on earning assets and cost of funds. We can see the yield on earning assets picking up 14 basis points quarter over quarter, very strong. We saw in the second quarter there was a lot of repricing of the assets, so we saw that pick up. That was strong, but also that cost of funds continues to increase, and that trajectory is stronger. We go from 0.55 up to a 0.61. So we see that increase much quicker than we've seen over the past several quarters in here. And that's something that we need to keep an eye on as we progress through this year. I think this trajectory is going to get steeper and steeper, kind of like that rubber band effect where we've been increasing that short-term rate, but deposit rates really haven't changed that much. And I think we're getting to that point where that rubber band is going to let loose, and we're going to start to see these cost of funds begin to rise at a faster and faster pace. And we should see that next quarter when we look at the third quarter numbers. I would anticipate this overall level cost of funds to increase. We're up 6 basis points here, maybe 7, 8, or 10 basis points in the third quarter. But when we look at the overall loans to assets, and this is helping that yielding earning assets to grow, we continue to see this increase. We're up to 70.85% of assets as you can see, year over year coming up from where we were last quarter at 69.36. So we continue to see this push, this ramp up in the overall loans to assets. And this is where the regulators are coming in, focusing on that liquidity during their examinations, because as the overall loans to assets increase, that the liquidity kinds to dwindle down. So keep an eye on that and make sure we have those contingency plans, the contingency liquidity plans in place, and that we're going through that stressing effect when we're looking at liquidity. The regulators are going to want to see that you're going through that process to stress your liquidity situation and how it would impact the bank. So it's important to keep an eye on that. But again, this is what's one of the things that's helping the overall level of yielding earning assets to increase. That coupled with the slight increase in those long-term rates that we've seen over the past year. We've seen them come down a little bit in the second quarter, down to that now, that 283 on the 10-year. And I think I continue to say that we're going to be between that 285, 295 by the year end, and we're going to continue to operate in that range. Overall, when we look at the cash type deposits, we can see, and this is something we've seen for some time, the continual increase in the level of cash type deposits. And we saw this quarter over quarter come down a little bit. The scaling makes it looks fairly large, but we're really going down from a 72.61 to a 72.24. So it has narrowed a little bit. But when we look back throughout history, where the average was closer to that 50%, being up at that 70 plus is a big ramp up. So this cash type deposits, if you recall, these are just non-maturity deposits. So your savings, your MMD, and your checking accounts are all built into here. When we look at then the overall cost of interest-bearing deposits, we can see the increase similar to the change in the cost of funds. This trajectory is starting to steepen. So when we look at this and we project this forward, we can anticipate this continuing to increase at a faster pace. I would not be surprised if next quarter, when we look at this, we're closer to the 80 basis point mark. So we're looking going up maybe 9 basis points in the third quarter. And this is just the repricing that we're starting to see happening in the market in general, in the deposit arena. The need for deposits is just giving us that pressure to push those deposit rates up. And then also just the overall market, the short-term market rates have gone up so much. Now the depositors are coming in and asking for those rate adjustments. And we continue to see this happen more and more on those cash type deposits. So it was once very low, inexpensive, cheap deposits are now starting to be more and more expensive. However, still cheaper than the overnight funding cost of around 2%. So we got to keep an eye on that and understand that as long as we're below that 2% funding cost overnight on your core deposits, you're doing really well. But we want to try and keep these down as long as possible. Flipping from the net interest margin to net overhead, we can see we're down from where we were at the end of the year, down 6 basis points. And if you recall, the net overhead is the difference between the non-interest expense and non-interest income. So overall, non-interest expense is similar to where we were last year in the second quarter, both at 2.76. So we're balanced there, down slightly from where we were last quarter at 277. So on the expense side, no real big change. However, on the non-interest income side, you can see we're up 3 basis points from where we were in the first quarter, from 54 basis points up to 57 basis points. So continuing to make headway there, but similar to where we were last year at this time. When we're looking at the tax burden though, and this is the impact of the new tax law, you can see for the broad overall community bank group on an aggregate level, last year at this time for the second quarter is 23.38%, and this year is 16.14%. So you see the impact of this new tax law. But when we look at it in terms of the two segments of the banking environment, the community banks that pay taxes on the federal side, there's a much bigger difference. So we look at the stock and that mutual subgroups. Last year, we were around that 30% tax bracket, and now we're down to about 21% on average. So we're picking up 9% of our earnings. So that's pretty significant. That's helping that overall increase in the yield or in the return on average assets. Been very beneficial. And right now what we're saying, to be tax efficient, you need to be below 16%. So we want to have a tax burden that's below 16% to be really tax efficient in here. So that's where that new nugget is right now, where we want to try and get our tax efficiency down to. And to do that in a number of different ways with the tax-free loans and credits, as well as those tax-free municipal investments. When we're looking at risk, so we saw the overall level reward increase, we saw the ROA picking up, the overall level of risk in here, slight increase in risk, not a big jump in risk on average for the community benchmark group. So that's a positive. And that's primarily because the changing of the ROA, a lot of that is due to the overall level of the taxes. And that's been a big benefit. But we did have a slight increase in risk, and that increase primarily came in terms of the earnings at risk and liquidity risk. So those are the two areas that had a noticeable increase in the risk. If you recall, built into the overall risk index, we look at the earnings at risk, credit risk, capital risk, and liquidity risk, and then we build in there an economic risk as well. So that's where we are today, and we look forward to continuing to report on the economy as we move forward, and also looking at those crucial deposit rates and where we see the current rates on deposits and those specials that are out there. We look forward to talking to you again. Have a great week, everyone.